You can find the return on equity metric by going to Yahoo Finance, go to the statistics section and scroll down to return on equity. The price to earnings ratio, as I said before, it's a great metric, but it's missing one key component, the growth of those earnings. This matters because if earnings are going to double each year, it affects the value of the stock and the return that you'll get in the future. The PEG ratio takes into account growth of earnings. It is calculated by dividing the PE ratio by the growth rate of earnings, and just like golf, you want this number to be as low as possible. The lower the PEG ratio signals the cheaper the price, the higher the earnings, and the higher the estimated growth. You can find the PEG ratio by going to Zacks.com to fundamental charts and click on the PEG ratio. Also, a lot of these ratios in general will come up when you type in the stock and the ratio that you're looking for on Google. Funnily enough, Google has the answers to a lot of things in life. As a business owner, two of the most important metrics to look at is 1, revenue, aka how much is the business making in total, and 2, earnings. After I deduct expenses from the revenue, how much do I actually keep? You want both of these numbers to be obviously as high as possible, consistent, and also very important growing. Yahoo Finance gives you a nice overall picture so that you can see what's happening with these numbers. The green is revenue, the blue is earnings. So this is Apple stock. As we can see, both have grown nice and consistently did very well in 2021, but also slowed down slightly in 2022. Also, you can go and check analyst estimates for how much they expect revenue to grow by in the future, and you can check how much earnings are expected to grow by if you go into the analysis section of Yahoo Finance. Yahoo Finance is a very good website for investors. By the way, now if there's one thing that we learned in 2022 is that debt is a dangerous game. Just go ask Sam Bankman-Fried, Credit Suisse, or Evergrande. They'll tell you how much trouble debt can get you into. If you get into too much debt, things can all come crashing down. But how do we tell how much is too much? There are two key ratios to look at to assess a company's debt level. First is the debt to equity ratio. This ratio compares how much debt the business has to how much money or equity the owners actually have in the business. Naturally, you want more equity than debt. The current ratio is also very important because it gives you a clue if the business can survive in the short term. The current ratio is a business's current assets minus current liabilities. So current assets are all of the assets that can be made liquid into cash within a year. Current liabilities are all liabilities that must be paid off within a year. What happens when you have more current liabilities than current assets? Your business is doomed to become insolvent. Warren Buffett likes a current ratio of at least 1.5, aka current assets are at least 50% more than the liabilities in the business. This ensures that they are solvent and sound in the short 1-year term. The economy is made up of sectors and industries. You want to pick out the sectors that will perform over your investing horizon. The economy has 11 key sectors. One is the technology sector. This includes stocks like Apple, Microsoft, Nvidia, IBM. 2 is the financial sector. This can be banks like JP Morgan or Wells Fargo. It can also include insurance stocks like AIG and Chubb. 3 is communication services. Stocks like Google, Matter, or T-Mobile. 4 is consumer, cyclical. These are businesses that sell non-essential goods. Amazon, Tesla, and McDonald's come under the sector. But if you ask me, McDonald's is pretty essential. 5 is consumer defensive. These include companies that manufacture food, beverages, and other essential items. Walmart, Costco, Target, or come under this category. 6 is the healthcare sector. I'm guessing we all understand healthcare and the types of companies that would fall under here. 7 is industrials. These are businesses that aid other businesses in manufacturing, shipping, or producing products like the Boeing company makes planes for airline companies to use. 8 you have the real estate sector. Obviously based around buildings, both commercial and residential. 9 is energy, so oil and gas companies. 10 is basic materials, companies that work with raw materials. And 11 is the utility sector, like electricity companies and water companies. Okay. Now take a look at all of these sectors. Which of these do you have a somewhat decent understanding of? Which sectors do you think will perform the best over the next 3, 5, 10 years? Weigh up your options and start building the portfolio in the sectors that you can make sense of. So I just want to say congratulations. If you made it up to here in the video, you've actually put in some effort and you've not just clicked off and you've watched some, I don't know, what do people watch online? cool dance videos or whatever. Now before you go out and buy a stock, you really want to learn how to study a business. Remember, a stock is a business. So before you buy, learn it well. So let's say you're looking at buying Apple stock. Okay, now I need to learn. How does Apple make money? They sell iPhones. They sell their Macs. They sell wearables. They have their services section like Apple TV, iCloud, and Apple Pay. If I buy the stock, I own Apple. So how will these income segments do in the future? Will more people buy Apple products? Is the wireless headphones doing well? How are they? What you're doing? Think like a business owner and ask these questions. Look at consumer behavior and what your friends are buying. What products are your friends like? What businesses are benefiting from the products they like? Just be that nerd who debates others on the value of a stock, on how good businesses may do in the future. Instead of overly focusing on politics or things that don't affect you as much, learn business is going to help you so much more in life, and it will help you with your investing and your net worth. The market is a crazy thing. One year it's running hot, and you're making money in every stock that you buy. The next year a recession has come and most of your stocks are down. This is the nature of the market. You need to make sure that you're in control, and not the market dictating you. What most investors do is they allow the tide of the market to suck them in and then spit them out, and they often tend to lose money. They get drawn in as prices get higher and higher, they become greedy, and when the market falls they panic, sell, become irrational, and they lose money. One way to avoid this is by having a game plan. The market will behave erratically. It's very hard to predict. So if the market goes up, what's your plan? Is it to potentially sell for higher prices, or is it to just hold your stocks? If Jerome Powell raises interest rates and a recession comes, what will you do? If other investors panic and sell the stock that you bought, will that affect you? Will it affect your style? If there's another lockdown and business is closed, will you keep buying stocks? These are the type of questions to answer, because it's vital to be prepared for what the market might throw at you. Be rational while everyone else is being emotional. The worst thing that you can do is get overwhelmed by all of the information and just give up on making your first investment. If you are overly meticulous, you'll end up waiting forever. Inflation will eat away at your savings and you'll stay poor. Even if it means slowly. Starting with passive investing and index funds, dip your feet in with a little bit of money so that you can start learning the game. It is a fun game. It is fun to make money, but start small and play the game wisely. So that should give you a good overall idea of how to get started in the market, some strategies, some ratios to look for, and some simple guidelines to follow. Remember, if you want to go more in depth into the investing world, you can sign up to the Investing Academy, where we look deeper into what experts are buying, my stock portfolio, and teach you even more about the investing game, because investing is important. If you don't learn it, you're going to find it very hard to get or maintain wealth, and if you don't have wealth, then you have less freedom to do what you want in this world. I love the game of investing. I don't know if you guys do, but I hope that you'll learn it more and end up loving it like I do, and I hope it makes you a lot of money.